This is not financial advice, not legal advice, for entertainment, educational purposes only, and anything I say is my opinion. Please don't make any financial decision based on anything I say in these videos. Listen, double check you're still subscribed to the channel. Double check your notification on. If you hit that like button, double check it's working properly. Guys, listen. A lot of the naked shorters, a lot of the guys or entities that engage in manipulating stocks in the United States stock market are having real liquidity issues. And here's the thing. The banks that finance a lot of these guys are in trouble. Their liquidity is drying up. And once the bank's liquidity is gone, they start margin calling. They start forced liquidations. They start forcing these naked shorters to close out these naked short positions, which never existed in the first place. But here's the thing. This will let you know that the liquidity is drying up. The Feds had to quietly push $13.5 billion into the reverse repo, okay? They had to do it secretly. Now, $13.5 billion isn't a lot of money on a banking scale, okay? It's not a lot of money on a banking scale. But the fact that the Feds had to put $13.5 billion into the reverse repo to keep it above zero is absolutely telling to me. It tells me that the situation is a lot worse than they're letting on. And if you watched my video yesterday, I think a lot of this has to do with Japan and the 0% yen loans that are about to implode and crash the entire market. But that's for another video. But the bottom line is this. The banks are having liquidity issues. And when the banks are having liquidity issues, that means that the bad actors, naked shorting AMC, GME, the ones who did MMTLP, BINI, NWBO, GNS, they are having liquidity issues also. And the situation has gotten so out of hand that the Feds are having to prop up the reverse repo with $13.5 billion. And guess what? That money is dwindling also. It was at like $7.9 billion. And I think it dropped to like under $6 billion. The bottom line is this. The banks are having liquidity issues. They can barely stay afloat. They're closing brick and mortar locations. And they're claiming it's because of online banking. That is not the reason, in my opinion. The reason they have to close the brick and mortar banks is because they cannot afford to keep them open. And if they can't afford to keep their brick and mortar branches open, do you think they're going to have a whole lot of funds available to lend to people that they know are naked shorting in the United States stock market? Bottom line is this. When the liquidity runs out, the banks are going to margin call. They're going to force liquidate because the banks are not going to go down with the naked shorters. Do they work together? In my opinion, conspire together to rob and steal from retail investors, pension funds, and institutions that follow the rules? Yes, they do. Because the banks know they're lending money to buy 1 million shares in a company, and the company only has 100,000 shares, but they lend it anyway. They know the shares don't exist. The SEC knows it don't exist. The DOJ knows it doesn't exist. The FBI knows it doesn't exist. But everybody practices willful blindness when a majority of the victims of these crimes are retail investors, pension funds, and institutions that follow the rules. Anyway, please leave some comments. Tell me what you think. Do you think the banks are in trouble if the Feds have to be secretly adding $13.5 billion to their liquidity? Anyway, have a great day. God bless, and I appreciate y'all on this journey with me.